It's Darius here at I-75 CPA Review. We're doing our part for quarantine relief. We're giving away scholarships. And if you haven't applied yet, you have until April 30th, 2020 to get that application in, because you could win FAR, Audit, BEC, and Reg, all 4 parts until you pass. It's about $1,000 value, and multiple people are going to win. So get your application in. Go to CPAexamtutoring.com, and when you get to CPAexamtutoring.com, up top on the menu bar, click Scholarship, and you'll be able to apply right there. Now let's talk about segments. So this is all about publicly traded companies. Segment reporting is required for publicly traded companies. Why? Because when you have consolidation of various entities, all that intercompany stuff gets eliminated, and you never see it on the body of the financial statements, right? When parent sells to this sub and this sub to that sub, you don't see that because it's all been eliminated. So where do you get to see it? You want to see it somewhere. You see it in a disclosure known as segment reporting. That's where you see all the intercompany transactions. They're not in the body of the financial statements, but they're disclosed separately in segment reporting. And on slide 3, that's the advantage of segment reporting, because users of financial information typically only see totals. Total sales, total expenses, highly aggregated information. There's a term you probably didn't learn in high school or college. Aggregated means high level, right? So you only see the high level information with regard to sales and expenses on the income statement. So segment reporting allows the same financial statement users to enjoy disaggregated information, like what percentage of the sales came from the Southwest division or from segment A. So on slide 4, an operating segment has its own revenues and expenses, maybe by geographic area, maybe by product line. It has discrete financial information. It has traceable cash flows. Not just how much did the company earn, that's good on the financial statements, but in the segment disclosures, we want to know which segment earned it and where was it earned. And it all starts with this thing called the 10% test, and this is where the exam will probably go. Publicly traded companies, they're required to report on business segments, but how do you know if a segment of a company is a reportable segment? Well, it's reportable if it satisfies at least one of the following 3 10% tests. So there's 3 possible 10% tests. It's got 3 chances to get in the door. If it gets in the door by satisfying any one of the 3 tests, then it's a reportable segment because it passed the 10% test. But the 10% test is really 3 separate tries. You got 3 tries to meet the 10% test, and those who meet it are discretely reported as a segment. The segment's revenue and that segment's expenses are reported separately. And this is key, where it says whether selling inside the company or outside. If your segment represents 10% or more, it must be discretely presented. So if we had to count the sales that your segment made to another segment of the company, not to outsiders, but to another segment, you got to count those sales also. So count the intercompany sales to see if you meet the 10% test. Obviously, count all sales, not just intercompany. Count the sales to outsiders and inside segments. Count all the sales that your segment had to both outside companies and to other segments within the organization in order to meet the 10% test. And that's usually where they focus on the CPA exam, right there. So the revenue test, you count intercompany revenues in order to meet the 10% test. When we get to assets and other things, we'll talk about that. But the intercompany really only relates to the revenue test. So let's start with the revenue test, because we know that for the revenue test, both arm's length sales and related party sales count. So let's see how that works. How will that likely be tested? So here's the 10% test with regard to revenue. Boardwalk Corp has 4 segments as shown below. Segment revenues are stated here as a percentage of Boardwalk Corp's total revenue. So it adds up to 100%. And you can see that 3 out of the 4 segments contribute more than 10% to the total of Boardwalk Corp sales. Fascination contributes 17% of revenue, Skillo 20%, Gateway 57%. Only Aqua doesn't meet the 10% revenue test, right? Now, right, Aqua has not met the 10% test, so if we just had this one test and we didn't have the other 2 10% tests, if we just had the revenue test, Aqua would fail. And your only 3 segments would be Fascination, Skillo, and Gateway. And to get to 17%, we didn't just count Fascination's sales to outside companies. We also counted Fascination's sales to Skillo, and Fascination's sales to Gateway, and Fascination's sales to Aqua, you see? In order to get that 17%, we counted all of the sales that Fascination made. All of the sales that Skillo made came up to 20% of revenue, both to outsiders and to other segments. Skillo contributed 20%, Gateway 57%. But Aqua, even when we counted the intercompany sales, could only make it to 6%. Outside and inside only made it to 6% for Aqua. Now, on the bottom of 8, it says, using the 10% of revenue test, Fascination, Skillo, Gateway, they would qualify as reportable segments. Only Aqua would fail to be a reportable segment since Aqua only accounts for less than 10% of total Boardwalk revenue. Let's go to the next slide. Fortunately for Aqua, there's 2 more tests that we can give Aqua to see if they can get in the door. They failed the first test, but there is going to be an asset test and a profit and loss test to see if they can get in the door some other way. Maybe there's a side entrance into the building for Aqua because they can't come in through the revenue test, right? They're not a segment yet. So there's 2 more tests we can give Aqua. Now, the good news for those tests is that Fascination, Skillo, and Gateway, they don't have to pass those other 2 tests. They're already in the door as a reportable segment. So when we go to the next test, which is the asset test and the profit and loss test, we're really only going to have to test Aqua. We're not going to have to test the other 3. The revenue test is the one they're likely to ask on a CPA exam, not so much the assets and the profit and loss. This is where I usually see the question. So here, now you're seeing that Fascination sales to unaffiliated customers are $33,000, and Fascination sales to the other segments are $6,000, total of $39,000. And then Skillo, same thing. They had sales to unaffiliated customers, they had inter-segment sales, but they all count toward the 10% test when we do revenue, right? We're counting both. Same for Gateway. Gateway sales were $100,000 to unaffiliated, $30,000 inter-segment, but all $130,000 is going to count toward their percentage to get to that 10%. But poor little Aqua only got to $15,000, and when you divide $15,000 by $160,000, no, $15,000 by $230,000, Aqua doesn't pass the 10% test. But Fascination does, because $39,000 is greater than 10% of $230,000. Right? What was Fascination's percentage? Go back a slide. It was 17%. But you could crunch the numbers. 39,000 over 230,000 should give you the 17% for Fascination. Skillo, Gateway, they passed the test no problem, but not Aqua. But notice how we count both sales to unaffiliated and inter-segment sales to get the revenue to use for the 10% test. Note how we get the total revenue in the last column. We get it by counting both sales to unaffiliated, arm's length sales, and also the inter-segment sales. And that's why I highlighted the $230,000 figure and not the $160,000 figure. We're not interested in that $160,000 figure, but they'll give it to you on the CPA exam in this question. And that's why this is the question I would expect they're going to ask you. One on the percent of revenues, not so much assets or profit and loss. This is the more popular one. So slide 10 just continues on and says which segments are considered reportable segments using the revenue test. And they'll give you all this information on the exam in the table. And the answer is B, right? Gateway, Skillo, and Fascination, because they passed the revenue test. And they're based on the $230,000 of combined revenue. Notice how we eliminated the $70,000 in the last line for consolidated revenues of $160. But for the 10% test, we're interested in combined revenues. And that's what makes this a very good testable question. Because half candidates would probably figure, all right, I'm not going to use the combined $230,000 because I know to eliminate intercompany transactions with related parties, right? Yeah, but not for segment reporting. The whole point of segment reporting is you've already eliminated those intercompany transactions in the body of the financial statements. Now, where you're going to report them to the users of the financial statements, you've got to have a segment disclosure for those transactions, and that's what we're doing now. Once again, Boardwalk Corp has 4 segments as shown below, but now we're going to do the asset test because poor Aqua hasn't gotten in the door yet, and you know they're feeling a little triggered and probably a little butthurt that they're not included here. So let's see if we can't get them into the party. So Boardwalk Corp has 4 segments. Segment assets are stated as a percentage of Boardwalk Corp's total assets, and now you can see Fascination at 55%, but we don't care about them. They're already in the door. Same with Skillo. Gateway doesn't make it past the asset test. Does that mean we have to push Gateway out the door? No. Exactly. Once it qualifies under the revenues test, we don't care about the other tests. We're only doing this test for Aqua. And when we do it, we see that Aqua qualifies because their assets are 22%. So come on in, Aqua, you've made it. So using the 10% of assets test, Aqua would qualify as a reportable segment. Gateway, even though they don't meet the test, they're already in because they met the revenue test. The only place you have to worry about intersegment is the revenue test. The asset test, yeah, that wouldn't apply. Intersegment wouldn't apply. The only thing you would have intersegment would be revenues, right? Not assets. Okay, so go to 13. Which of the following factors determines whether an identified segment of an enterprise should be reported in the enterprise's financial statements? Number 1 says the segment's assets constitute more than 10% of the combined assets of all operating segments. Boom. If that's the case, you're in the room, right? You're a reportable segment. 2, the liabilities. I don't know. Is there a liabilities test? No, there is no liabilities test for segments. There's an assets test, there's a revenues test, and there is a third test, but that's a profit and loss test dealing with the bottom line of the segment. Nothing to do with liabilities, but it makes for a great wrong answer. So not so. Liabilities do not get fair treatment here compared to assets in this test. So the answer is 1 only, letter A, and they could easily ask that, and a lot of candidates would be like, oh, I did look at this once. If I only would have looked at this one more time before my exam, I would know that there's no liabilities test. Now for test number 3. So you didn't pass either of the first 2 tests and you still want to get in the room? There's the 10% operating